So I first want to introduce Kate Warren. Kate Warren's PhD CFA has been with Edward Jones Research Department since 1997. She was named a principal with the firm in 1999 and became a member of the Investment Policy Advisory Committee in 2003. Kate is the firm's investment strategist, interpreting market conditions and recommending appropriate long-term investment strategies to aid the firm's more than 7 million clients in reaching their investment goals. She holds a doctorate in economics, specializing in finance and competitive strategy from Yale University, a master's of science from the London School of Economics, and a bachelor's degree with high honors from Swarthmore College. Basically, she's got a lot of initials behind her name. You know, when I graduated from college, I didn't get magna cum laude. I got laude how come. So Kate earned her Charter Financial Analyst designation in 1997. She has appeared on CBS, CNBC, CNN, BBC, Canada's CBS, or CBC, and Business News Network. She has been quoted in such major publications as the Wall Street Journal, the New York Times, the Globe and Mail, the Financial Times, Forbes, and Fortune. Upon the completion of her talk, we're going to have a short Q&A, and then we'll go to our next speaker, just kind of let you know how the agenda is going to work. So without further ado, Ms. Kate Warren.
Thanks very much, Robert. Can everybody hear me okay? Okay, so I'm going to talk about U.S., international, and organize this in terms of markets and economy. But I wanted to start with the markets, since I think that's really where more of the questions are, even though this is an economic outlook. And I think I'll stand over here. So sorry for the people behind the pillar, because I'll wander back and forth. All right, so markets clearly have returned to volatility. Last year, things seemed pretty smooth, probably when you had this talk. But of course, we saw the first correction in a while, back in August, and now we're in another one just recently. Keep in mind that these are 2 of only 4 corrections we've had since the bear market that ended back in March of 2009. So we've actually had a lot less market volatility than we've had historically. When you look at the table going back to 1900, what you can see is we usually have 3 or 4 dips or 5% pullbacks every year, and one of these corrections like we're in now about every year. So, but I'll bet it doesn't feel like this is something where you have one every year, right? So not so much, right? But I think that helps put this in perspective. And the reason I'm emphasizing it is that with it being one of 4 over almost 7 years, we're sort of thinking this is unusual when in fact this is just sort of normal stuff. The reasons aren't always normal, but this is actually pretty normal. And eventually we'll have a bear market again. That's a 20% decline. So we haven't had one of those since 2008, 2009. We don't think that we're headed into one. So let me say that right up front. But one of the things to keep in mind is we will have a number in the future. Keep in mind, just looking around the room, if you think about yourself as being invested over, say, 40 years, so most of you would have an investment horizon like that. So how many bear markets do you think you'll have to invest through? If, in fact, they happen, use 4 to make the math really easy. Anybody got a guess? I got 10 over here, so I got somebody who's doing the division, right? So if you know you're going to go through 10 bear markets, then what do you need to do? You need to stay invested, but you need to understand that those happen regularly, and historically the returns on the market have been just under 10%, rewarding those who stayed invested. Now the reason I spent a little bit of time on that is that an outside group named Delbar fortunately didn't survey Edward Jones clients, they surveyed somebody else's clients. And what they found was the average return that actual investors got, 5.2% per year, the little orange bars. If they just stayed invested over the last 20 years, they would have gotten almost that 10% per year, 9.9%, the big green bars. And that's because frequently people think they need to trade when somebody says, oh my gosh, it might get bad. They buy what? What are you supposed to do? You're supposed to buy low, right? So they buy high and they listen to their neighbor's advice. So keep in mind, they get stock tips from people they shouldn't get stock tips from. And they sell when? Low. They sell during times like this, as opposed to keeping their money invested. They also do it with bonds. So the other mistake people make is to sell bonds when they think that, oh my gosh, interest rates are rising, own your bonds. They'll still provide good returns and they'll help stabilize portfolios. I'm going to organize the rest of this in terms of questions I'm getting from groups like yours. And then, as Robert mentioned, we'll have time for a few questions before we turn it over to a more local look. But the first one really is all about the economy. It's, basically, is the economy slowing down? So let me start with that. We think the answer is not, although we did see 0.7% growth in the fourth quarter. So you can see the pattern, though, which is we frequently see times where quarterly growth rates have slowed down just like now, and then they've rebounded. The forecasts we have here, we don't do specific forecasts ourselves, are consensus forecasts. They're always smoother than reality, so don't look at that and think, oh my gosh, growth is going to smooth out. We actually think it's going to continue to be very bumpy quarter to quarter, just like we've seen so far. But it's going to average between 2 and 2.5% in the same range as what we've seen during this entire slow expansion. So not much of an acceleration, not a deceleration, just more of the same. That's been good enough to support good stock market returns. It's been good enough for basically the economy, but it's been very frustrating. What's supporting it? Well, before I get to that, what's the big issue right now? It's the slowdown in manufacturing and in international trade. And the reason I've got this chart up here is it's ISM manufacturing. And you can see the shaded areas like this are past recessions. But if you look at ISM, it frequently drops between recessions, and we're seeing that right now. We actually think this is just one of those slowdowns where, yes, the manufacturing sector's been hit by the strong dollar, basically by the high oil prices, because a lot of it's tied to that, but that it's not going to lead into an overall recession, just a period of soft growth. What are we looking at? Well, we're looking at continued job growth, around 200,000 per month, just like we've seen over the last couple of years, maybe a little bit slower, as you can see at the end, but still very solid, and consumer spending still accounts for about 2/3 of the economy. So in terms of our outlook, it really depends on the consumer continuing to do well. And I'll talk about oil prices in a minute, since it obviously is something everybody here wants to know about. But we actually think part of what bolsters it over the next year or so are the low oil prices. People have been saving their savings at the pump as opposed to spending it. We think over time, what you're likely to see is more of the spending. We also know that consumer confidence has remained high despite the market volatility, and the consumer's ability to spend, and this is household debt service. It just says what percent of monthly incomes are being spent to pay off mortgages, credit card debt, student loans, all kinds of debt. You can see it's at the lowest levels we've seen since they started keeping data back in 1980, so we don't have data before that. That says the consumer's capacity to borrow is really high. And what are they doing? They're out there buying cars, they're buying houses, they're doing all the big ticket items. They're just not doing as much of the smaller things that all go into retail sales. So we actually think that's a pretty strong vote of confidence that consumer spending will continue to grow. That keeps the economy growing at about the same pace at a little more than 2%. The last thing is we know that this expansion has lasted longer than average. Average expansion is about 5 years. We're now into 6.5. So CBO forecasts that this one would go for another few years. We don't look out that far, I'll have to confess. And economists' forecasts are notoriously unreliable. So don't take that further out. But usually at a time like this, we can begin to see signs that the economy sort of is slowing down, and we're not seeing any of that. In particular, keep in mind that expansions don't die of old age. They're usually killed. And there are two things that are typically known for killing off economic expansions. The first one is a spike in oil prices. Oil prices likely to spike? What do you think? Aren't they going the other way? Right? So not likely to be killed off because oil prices suddenly rise dramatically and everybody suddenly has to adjust to that. And the second thing is a Fed who's saying, The economy's way too robust. We need to raise rates rapidly and slow down the pace of economic growth because inflation's gotten out of hand. Has anybody heard the Fed say something like that recently? No. The Fed's at the opposite end, saying we might not even raise rates above the 0.25% they're at this year because economic growth is so slow. So I want to really emphasize the fact that usually we see something that's beginning to go wrong before the economy slows down, and we're not seeing any of that. All right, so what about the stock market? Can the stock market rebound? We look at 4 factors when we get that question. The first one is, are we continuing to see economic growth? The answer we think is yes. Are valuations too high? We think the answer is no, so I'll give that one a check mark. Look at earnings growth. That's where the problem's been. Earnings growth hasn't been all that good, largely dragged down by the strong dollar and by the drop in oil prices. And then the last one is we look at sentiment. So I'm going to go through, as we talked about the economy, but looking really quickly at valuation. Price earnings ratio on the S&P 500 large cap stocks, pretty much in line with its historical average, right around 16 times forward earnings. Historical average is a little more than that. So valuations look okay, especially with the pullback we've seen this year. Stock market, in our view, is not overpriced. It's also not super cheap, but it says stocks can continue to grow if we begin to see better earnings growth. And that's really where I said the issue's been. You can see the little decline in earnings that we had with third and fourth quarter earnings negative on a year-over-year basis. But a lot of that's due to the fact that energy companies in the S&P 500 have year-over-year earnings contraction of about 70%. So you take a part of the S&P 500 being dragged down by this incredible drop in energy earnings, which you're all familiar with. And that's why we're seeing that negative year-over-year growth. The second thing that many other companies have been talking about is the fact that the strong dollar means they're making a lot of money in the rest of the world, but when they bring it back into US dollars, it's down in dollar terms. So we think both of those are likely to correct later this year as oil flattens out and the dollar flattens out. So not necessarily a falling dollar and rising oil prices, just both of them getting less bad gives us earnings growth. The last thing to talk about sentiment is the economy and the election, because many people are thinking, oh my gosh, we could see an election that really disrupts the economy. Now, we don't know who the candidates are, and I will confess that there's a little more uncertainty this year than there has been in past years. But when we looked at the history, what we found was that the stock market here, as you can see, under every combination in Washington has grown over time, and usually at double digits. The economy, measured here by industrial production, you can see has been positive, and there are differences. So it's not that it doesn't make any difference, but in our view, the market and the economy doesn't pay much attention to Washington. You'll hear lots of proposals being made by the candidates. Very few will be enacted. So, and the market usually pays attention around September, October. So if you're thinking about, oh my gosh, I need to see the resolution of this uncertainty before you invest, our view would be, no, put your money to work, because there's a lot of stuff that will happen between now and then. Makes no sense to sit on the sideline worrying, and it doesn't make as much difference as most people think. So there are 3 risks that we think are far more important than the election, and that's what's going on in China, what's happening with oil prices, and what the Fed might do. So that's what I'm going to talk about next. In China, we've seen the economy slow for the last few years. Interestingly enough, it's only hit investors' attention, or the market's attention, or the economy's attention recently. China is now the 2nd largest economy in the world, second only to the US. Its slowdown matters. We've faced this as, it used to be that what went on in China stayed in China. Now it's not Las Vegas any longer. It will, in fact, affect the rest of the world. But it's been slowing down. We think it'll stabilize around 6.5% growth. It was just under 7 last year, because Chinese policymakers, even though they're going through a transition from export-led growth to more focus on the consumer, it'll be bumpy. We think they want to be sure it stays in that range. What we saw was the Chinese stock market double and then halve. That caught everybody's attention. We don't think the Chinese stock market's a very good indicator for the Chinese economy. And the reason is it's not how major companies get financed. But what we do think is that we're going to continue to see China affect the world, because it's now 15% of global GDP. It's much bigger as a relative part of the world than it used to be. Any economy going through a transition, in this case from export-led growth to consumer growth, is going to do it bumpily. So we think we'll hear more disruptions out of China, but we think policymakers have plenty of tools, cutting interest rates, providing more stimulus, controlling the currency, basically to do things to keep growth in about the range they want it in. But the main impact hasn't been so much on our markets, it's been on our headlines. It's really been on commodity prices, and especially in emerging markets, and especially oil. Which brings me to the next question, and one close to everybody's heart here, what's with the oil markets? Now, I used to follow energy for Edward Jones. I'm not the energy analyst any longer, but let me just give you a high-level overview with our views. Clearly, the drop in oil prices was a surprise, has been down 75% over the last 18 months. We've seen drops like this before, though, and all of us are familiar, oil prices drop, then they rebound. We think this time isn't different, but it will be a little different on the rebound. And the reason is, when we take a look at the production reaction to low oil prices, what would you normally expect? Oil prices drop, what do producers do? Cut back, right? Have we seen that? Not so much. What we've seen is drilling cutbacks, but what has happened to all the drillers? They've gotten a whole lot more efficient. So they've lowered the cost at which, even in the shale, people can make money. So we've seen this really massive production response here, and that's what we're likely to see more of this year, but it's still going to be muted compared to what we've expected in terms of the price reaction to low prices. And what about producers in the rest of the world? Are they cutting back? No, they're doing the opposite. In fact, there's rumors today that there's an agreement among Russia, Saudi Arabia, a few others, to stabilize production where? At the highest levels they've been at in decades. Does that suggest to you that anybody is really cutting back on production? No, not so much. So our view is this is a big game of chicken, and that you won't see oil prices stabilize or even think about rebounding until we see some kind of significant production cuts. Because right now we've got about 2 million barrels a day extra production compared to demand. The good news is demand is growing, it's just growing slowly. So that to us says we're not likely to see the stabilization of oil prices even where we are. They don't necessarily have to go a lot lower from here, but you need to see some sort of major production cutbacks. At the same time, though, we also know that when that occurs, the rebound's likely to be slow, and that's because we have a huge level of inventories. So that even when prices begin to rebound, we have a lot of oil that will come on the market, both from producers who have capped wells and out of storage. So what's our takeaway? Rebound isn't anytime soon. We do think prices will probably stabilize in the second half of the year, but we'll need to see some other things happen between now and then. We do expect bankruptcies. We think countries might default, like Venezuela. So there's more pain ahead that especially affects high-yield bonds, as well as, obviously, any of the energy producers. That says to us, you want to own energy producers that can manage through a sustained period of lower prices, as well as energy users. But our focus would be far more on the energy users. And the good news takeaway from all of this, if there is some, is that low energy prices historically have helped boost economic growth. That, of course, boosts demand. So this does have a long-term silver lining, which is demand will continue to grow. That helps not just the US, where that's always been the case, but Europe, which is a net importer, China, and Japan, all areas of the world that where people have been concerned about the pace of economic growth. So that's good news over time, but it's not good news short term. So what about the next one, which is interest rates and the Fed? Clearly we know that US interest rates are low, right? Anybody think US interest rates are high? You love all those rates you get, right? Unless you're borrowing on a mortgage, in which case they look great. But US rates, actually up here, it's a little hard to see. These are US rates, these are European rates, and these are Japanese rates. Are US rates high compared to, or low compared to those in the rest of the world? No, they're actually extraordinarily high. So in the rest of the world, if you put your money to work for 10 years in Switzerland, you get back less than what you put to work. So Swiss rates are negative. Imagine how happy you would be if you invested for 10 years and you got back, you put in your $10,000 and you got back 9,500, right? That's what they're doing. Does it surprise you then that people in the rest of the world are moving their money to the US because we have relatively high interest rates? That's likely to keep long-term interest rates relatively low over time, and it's also part of the reason the dollar is strong. So we all know the Fed hiked rates in December, 0.25%. We think the Fed will be very slow because they're in no rush to continue raising rates. But the focus has meant that bond markets are more volatile than usual. Our view is that we will see rates rise over time, but it'll be extraordinarily slowly. We think 85% of your fixed income should be in short and intermediate term fixed income, basically as a way to buffer your portfolio in any interest rate environment. But let's look a little more closely at this, because this is the Fed's rate hike over here that you can barely see. But we are starting from a much lower level of rates than what we've seen historically when the Fed does get around to raising rates. And we actually think they will raise rates probably 1 or 2 times this year. We're not sure, obviously fewer than what we were thinking at the beginning of the year. Historically, though, if you look at when the Fed started to raise rates, and this is the short-term interest rate in blue down below, you can see it always started from a much higher level. So in this cycle, not only are they starting from 0, not only do we think they're going to be slow and steady in doing it, but they're not going to get rates as high because it's going to take some time, and we'll probably head into the next down cycle before they've raised them for very much. In our view, that says you want to be sure your portfolio has the right mix of stocks and bonds, because historically, during calendar years, when stocks drop, bonds go up. These are the last 9 calendar years when stocks declined in the red down there, and the bonds in green have gone up each time. We've actually seen that over the last 6 months or so. Whenever stocks have pulled back, bonds have moved higher. When you think about holding a portfolio that's diversified, that's the first and most important piece to it, is to have that right mix so that your portfolio isn't as volatile as the market. If we look at a portfolio that's 65% in stocks, 35% in bonds, going back to the Second World War, and this is just an example of why we focus at Edward Jones so much on the right mix of stocks and bonds. Hold for 5 years, which for most people is a reasonable time horizon. Rebalance every year. It's never had a negative 5-year return. So it goes down within the 5 years. But if you can give your money 5 years, you can be relatively confident that you will have a higher value at the end of that time than what you had when you started. So it goes down, but you stay invested, and you're back 5 years later. All right, 3 last questions before I'll open it to yours. More international here. The dollar, because that's been the surprise of the last few quarters, along with oil prices. When you look at the dollar, what you've seen is a surprising strengthening, looking sort of on a short-term basis. That, as I mentioned, has hurt exports, which has hurt manufacturing. It's hurt earnings because of that drop in as they convert back into dollars. And it's also helped inflation. It's lowered the prices of imports. If we look at this in a slightly bigger, longer-term context, you can see this is just one of several times where we've seen sort of sharp increases in the dollar. The previous 2 have lasted 5 years in one case, 6 years in the other. When we look at the time when the dollar was sharply rising, doesn't say this time will be over shortly, but we've gone through 5 years of a strong dollar. So we were looking at this and sort of saying, if that's about the average time where the dollar strengthens sharply in this much longer term decline, we may be towards the end of it. Now, that's not the reason we're thinking the dollar will level out later this year. It just needs to increase less sharply for many of those impacts to reverse. And we're thinking this year what we see is better international earnings, basically less of a negative drag from the dollar. But I will give you one takeaway, which is the strong dollar has created a huge opportunity to buy international investments. The reason is the flip side of those weak earnings is using the strong dollar to buy cheaper stocks in the rest of the world. And that brings me to the next of my questions, which is, all right, so what is going on internationally? International investments have underperformed US investments, partly due to the strength in the dollar, because what it does is essentially lower the value of international investments. That's why they're relatively cheap today. We think it's created an opportunity, because as policymakers in the rest of the world have shifted towards stimulating economies, we're seeing that in Europe with the European Central Bank, we're seeing it in Japan, where they're still struggling with almost zero growth. We think one of the best times to put money to work is when policymakers are really pushing on economic growth, because that actually tends to be a time when stock equities go up. International equities are better valued with higher dividend yields, lower price earnings ratios, better expected earnings growth. We think it's appropriate for many people's portfolios. So we'd be looking at this and saying, take advantage of that strong dollar to give your portfolio a boost with the rest of the world. Now coming back around to why you might want to be putting your money in opportunities, we looked at basically this kind of pullback and said, how different is it from things we've seen in the past? Turns out that over the last 30 years, within every year, if you look at the red bars, the intra-year decline, so if you look at how far things drop, is about 14%. We're down about 12% right now, so we're very close to the bottom of the average intra-year decline. But year to year, stocks have gone up about 9, 10%. So that's why we're looking at this and saying, time to buy the dip. Where do you put the money? Well, we think it's in companies that have sustainable competitive advantages, called moats. Think about why a European castle had a moat. Anybody know? Protection, right? So the idea of these is these companies do something that's really hard for others to replicate. They've outperformed, as you can see here, and we combined that with something we always like at Edward Jones, which is dividend growth. Because if you look back to 1972, the dividend growers and initiators have provided returns of almost 10% per year, whereas the highest yielders have actually lost money, and the non-dividend payers have gone up only 2.5% per year. Now, they do great at times, but what you're really looking for at a time like this where there's more uncertainty is this combination of sustainable competitive advantages and dividend growth. You can get a copy of the report that was on the previous slide from any of the financial advisors who's here. But it gives a list of individual stocks, mutual funds, ETFs also own stocks like this. We think that's a place to be putting money to take advantage of this pullback in the market. One last point, though, which you'll think is sort of a little contrary, which is when we looked overall at that same 65% stock, 35% bond portfolio, and looked at what investors may need to do, stocks may not be the place you need to put money. We started back in 1995. Turned out if you never rebalanced your portfolio, you never looked at the mix of stocks and bonds, it had grown to 82%, so that 65 had just increased as the market increased up until the tech bubble burst, in which case if you hadn't rebalanced, gone back to the right mix of stocks and bonds, the market did it for you. Rather painful, right? Something we all want to avoid. Same was true before the financial crisis, the big 2008 pullback that we all worry about. If you hadn't rebalanced in advance of it, you were at 77% in stocks, not 65%. Today, that same portfolio, if you haven't rebalanced, is at 79% in stocks. Now, we don't see another huge downturn coming like the tech bubble or the financial crisis. What we know is that many people don't think to do this on a regular basis. Think of it as like flossing your portfolio's teeth, kind of thing that you need to do, but isn't something that you think of because it doesn't seem like anything's gone wrong. So our view is, yeah, there are opportunities in stocks, but make sure you've got the right mix of stocks and bonds. Pulling it all together, we think market volatility is back. We think it's a good time to be investing, though, in both stocks and bonds. Part of it is we see economic growth continuing, both in the US and the rest of the world. Valuations are reasonable. We think earnings growth will improve later this year as the dollar flattens out and oil prices start to find a bottom. So not necessarily going up, but flattening out. In our view, we think low rates may last for longer, but they won't last forever. What do you do in this environment? You basically look for opportunities. You make sure you have the right mix of stocks and bonds, and you stay invested. So I think I've got a couple of minutes, or no?
We've got a few minutes for a few questions.
So questions real quickly, and then I'll turn it over to Patrick, who will be able to do more on Houston. So questions?
Questions for Kate?
No questions.
Wow.
That's not
You did a
good.
great
That's,
job.
no, that's a bad sign. Okay. All right. Thank you very much. I appreciate your time.
Before you sit down, we have a gift, a token of our appreciation.
Oh,
for
thank you
being
so
here.
much.
Thank you.
Thank you.
Appreciate it. Okay, our next speaker is Pat Jankowski. Pat's a regional economist and vice president of research at the Greater Houston Partnership. He oversees the research department, which provides information gathering, data analysis, database management, economic forecasting, and mapping functions for the partnership's 5 divisions. Mr. Jankowski is a member of the Texas Economic and Demographic Association, the National Association for Business Economics, and the Commercial Real Estate Research Forum. Currently, he is the president of the Houston Economic Club and serves on the board of the Washington-based Council for Community and Economic Research. He received his economics degree from the University of Texas in Austin. Mr. Jankowski has worked for the Greater Houston Partnership and its predecessor, the Houston Chamber of Commerce, for 30-plus years. Without further ado, Mr. Patrick Jankowski.
Can you hear me? Okay, very good. Thank you very much for inviting me again to speak. This is Kate and I have done this a couple times, so she's given excellent presentation on the global economy. I took so many notes that I'm going to go back and review them again when I get back. And I'm going to tell you a little bit about what's going on here in Houston. So, real quick, but before I talk about Houston, I want to let you know, if you're looking for information on Houston's economy on a regular basis, I encourage you to go to our website. We've got the easiest web address in the world to remember. It's houston.org. And you just go to the economy tab, and we've got a monthly newsletter, a data sheet, some talking points, and some forecasts there, just so during the course of work, if you need some information on Houston, go there. So let's get started. Be real blunt. I'm not going to sugarcoat anything this time. Seriously, it wouldn't do you guys any good if I came out and told you everything was sweet and rosy, because it's not. One thing would affect my credibility. The other thing, though, it wouldn't be useful to you. So let's get started. Job growth has definitely slowed in the region. We had 23,200 jobs created last year. That's after years when we were creating anywhere between 80 and 100,000. So creating jobs at about a fifth the rate that we've created in the past. There have been some real clear winners and losers. If you look on the left-hand side, those are the sectors which created jobs. Look on the right-hand side, you can see the sectors which lost jobs. Luckily, there are enough sectors creating jobs to offset the losses in the sectors that were losing jobs. One of the biggest sectors was hotels, restaurants, and bars, followed by healthcare and government. When I say government, don't begroan that thinking it's, pardon Mayor, that it's city government. Government there is actually school districts. A lot of it's school districts. It could be community colleges, state-funded universities, and so forth like that. So in retail and so forth. But if you look on this side, you can see one of the biggest losses we had was in manufacturing, 16,000 jobs. And actually the losses would have been better. There's a category within manufacturing called durables manufacturing. Think of oil field equipment. Think of things that are going to last a long time. That sector actually lost 19,000 jobs. If it wasn't for non-durables, think of chemicals, think of bakery products, think of food, the losses would have been a lot more. But we added jobs in non-durables. Mining and logging, which is a category for oil and gas, 8,500 jobs. You would expect there to be more, but I imagine a number of those job losses are showing up in manufacturing. The question is Baker Hughes a manufacturer or are they an oil field service company? Actually, they're a little bit of both, so you don't know how they get classified. Wholesale trade, we're not selling as much stuff to the oil and gas industry. Real estate, definitely slowing down. But you get some idea of where the job gains and the job losses were. Unfortunately, if you look at this chart shows you the average weekly wage in each industry. This isn't the wage that was lost, but this gives you some idea of what they pay. The sector that we created the most jobs in last year only has an average wage of $380 a week. While the sector we lost the most jobs in paid over $1,400 a week. So yes, we're creating jobs, but we're not creating high-paying jobs, not creating jobs in the sectors that pay well. You look at healthcare, government, retail, the job growth there. But if you look here, every sector here but this other services sector pays well over $1,000 a week. Well, if you look at these other sectors, very few of those pay well over $1,000 a week. Most of them pay under $1,000. So it's going to have an impact down the road for retail sales, an impact for housing, an impact for multifamily apartments and so forth like that. Just kind of put it in perspective. Obviously, we're being driven by what's happening with oil and gas prices. Oil prices have fallen by $80, approximately $80 since June. They peaked at $107.95 a barrel on June 20th, 2014. It's kind of like a day that'll live in infamy. Remember that. And lately we've been trading below $30 a barrel. Huge drop off the oil and gas. And so everybody, it seems like everybody in Houston is following the price of oil the way they follow the Texans score. You know, it is important if you, at all the cocktail parties or functions I went to at Christmas time, people were asking about oil prices in your job, and the Texans. So, okay, so the question is, when will prices recover? I mean, everybody has their fingers crossed. Everybody's hoping to see oil prices recover soon. Well, the Energy Information Administration, the official watchdog, the agency for the federal government that gathers and monitors and studies the oil and gas industry, is forecasting oil prices to average less than $38 a barrel this year and average only $50 a barrel this year. And this is the federal government in its wisdom forecasting oil prices. Last year they thought oil would already be at $71 a barrel this year. So the Department of Energy doesn't have a real good handle on where they think oil prices are going to be. So, okay, let's go to the next one. This is the futures index. If you believe in the wisdom of markets, and the wisdom of markets tends to understand what's going on, and all the individual investors, all the individual buyers and sellers have worked it all out, and they have an understanding of where oil prices are going to be or should be. If you look at the wisdom of markets, we're looking at oil not getting above $40 a barrel until sometime early next year. Not even getting up to $45 a barrel by the end of next year, if you believe in the wisdom of markets. Of course, the wisdom of markets thought that oil would be at $56 a barrel last year. So really the futures market is having a hard time determining what oil prices are going to be. If you read the newspaper like I do, maybe, God, it can be depressing, can't it? Continental Resources CEO Harold Hamm thinks crude is going to be at $60 a barrel by the end of the year. Do you guys know who Harold Hamm is here? He's the guy who lost $1 billion in a divorce settlement. I think he needs a new lawyer. So if you look at Wells Fargo, excellent forecasting organization, they're saying the oil is going to be $40 a barrel this quarter and maybe get up to $58 a barrel by the end of the year. Barclays thinks we're going to have $37 oil this year. If you look at Morgan Stanley, they think we're going to have $20 oil this year. And Standard Chartered thinks we're going to have $10 oil this year. So the question is, no one really knows when prices are going to recover. Now we have a sense that when markets will balance out, and supply and demand will probably come in balance sometime in the middle of 2017, which will stop putting upward or downward pressure on prices, but it doesn't tell us when the prices are going to settle out at. They could settle out at 40, they could settle out at 50, they could settle out at 60. But we're still at least a year away, if not more, from supply and demand to balance out on a global basis. To understand how supply and demand is so out of balance, we've talked about inventories. Kate showed you a slide showing U.S. inventory of crude. The OECD, the Organization for Economic Cooperation and Development, think of the developed world, the first world, there is over a 3 billion barrel supply of oil in inventory right now. That's a 67-day supply. And that's going to continue to grow as we continue to pump. So really, it's going to take a while. Yes, we're seeing a little bit of growth. We need to see more growth. We're seeing a little bit of destruction of supply, slow down supply. But we're really not going to see oil prices recover for a while yet. So you talk about the rig count. This is a good surrogate for the manufacturing activity in the region. You think about, we're talking about oil prices, and you think about what's going on in that's like white-collar jobs, it's the office jobs. The rig count, think of that as manufacturing jobs. Think about it as blue collar. So you've got two sides in the industry, the white collar and the blue collar side. The rig count, we've lost 1,300 rigs from its peak in September of 2014. Think about it, we've lost about 67-68% of our rig capacity, and production has only slipped by about 500,000 barrels a day. It's like we talked about, the oil and gas industry has gotten very efficient at finding oil and gas. It's the efficiency of the process. It's understanding the geology. It's only drilling the best plays. So we really need to see, it would be nice to see the rig count pick up. It would be nice to see the oil and gas industry drilling some more wells. But that's not going to happen anytime soon because of this. This is a blog I follow called Oil Pro. The blogger went in and he added up the debt the 58 largest oil and gas companies have taken on over the last 10 years. And they went from having less than $50 billion in debt to having over $200 billion in debt. The oil and gas industry is pretty much laden with debt that it's going to have to pay off. And what's scary about this is 8 out of the last 10 years, the oil and gas industry has actually outspent its cash flow. It spent more on drilling than it was taking in. And it was doing that because the banks and Wall Street and private equity firms were willing to lend them the money. No one's willing to lend them the money anymore. They're worried about their investments. So you're not going to see drilling being driven by an increased access to credit. So Wall Street's not real happy with the oil and gas industry right now. This is the peak price of oil, the peak prices of these shares. These are all companies that have large operations in Houston, companies you guys probably all recognize, companies which are just down the road. Almost all these oil and gas firms, with the exception of a few, had share prices over $100 at their peak. Now look at where they are. They've fallen. You're lucky if you own Exxon stock, the price of your shares have only fallen by about a fourth or fifth, 22%. And if you own Marathon shares, think about this. Marathon share $7.49. I can go out and buy a Schlotsky, a bag of chips, and a drink for more than it takes to buy a share of Marathon oil stock. By the way, that is my favorite sandwich. So. But just think about that. A share in an oil company, a very well-run oil company, for less than $8. So Wall Street's not real happy with the oil and gas industry, and they're not going to be willing to lend them a whole lot of money anytime soon. And if you think about cash flow, about what they're taking for what they sell, now this violates one of those rules of presentations. There's an awful lot of numbers up there. Just look at what I've circled, $118 billion. This was their cash flow in the third quarter 2014. This is their cash flow, third quarter 2015. It's off by $118 billion just in that quarter alone. So not generating the revenue they need to be able to pay their debt, to be able to fund exploration, to be able to keep their payroll. So that's one of the things oil and gas companies do. They're cutting back on drilling and they're cutting back on staff. So and it's interesting. This is the point in the presentation everybody gets real quiet. I won't depress you the entire time, but if you do read the newspapers, though, and you pick up the magazine, it does get to be kind of depressing. It does get to be just a little unnerving. I mean, the Wall Street Journal, oil plunge sparks bankruptcy concerns. The Telegraph, English paper, oil could crash to $10 a barrel, warn investment bank bears. Chronicle, worst oil bust in 45 years, bring U.S. crude below $31 a barrel. And this is my favorite, the World Economic Forum. Is this the end of big oil? There are people out there who are actually rubbing their hands and they're happy to see what's happening to Exxon and to Chevron and to Hess and so forth. There are people out there who just don't see the oil and gas industry the way we see it here in Houston. And they actually like to see the fact we're suffering. Maybe finally the oil and gas industry will go away and we'll have all renewables as they get on their solar-powered airplane. So I have news for them, and I have news for us in the room. We've been here before. This is not the first downturn in the oil and gas industry. I'm 58 years old. This is my 5th downturn that I've lived through and I've worked through. It's like bear markets. It's like corrections. I was thinking when you were saying that, Kate, it's just, this is, and I'm 58, I plan to work, my boss will let me, a little while longer. I'll probably have at least 1 or 2 more downturns in my career before I finally retire. Oil and gas, it's a commodity-based industry. Commodities are very cyclical. And you can look and see some of them, the oil and gas industry took horrible hits, and some of them they took very mild hits. And I say this, that this is my 5th downturn. I've got 3 children. I have a son that's 32 years old, who's a geologist. And we were having dinner a couple weeks ago, and I'm talking to my son, Philip. It's great having a son who's a geologist because I can talk shop. Anybody have adult children? Isn't it great having adult children, the conversation that you have, and then when they give you that first grandbaby, oh, everything changes. But I was talking to my 32-year-old son, and I was saying, Philip, I'm kind of worried. I'm watching all the data. I'm gathering the anecdotes. I'm reading everything I can, and it just doesn't look real good out there. And I said, but this is my 5th downturn. And my 32-year-old son looked at me and he says, well, Dad, this is my 2nd. My 32-year-old son is going through his 2nd downturn in the oil and gas industry. And I look out there some of you guys are probably out there with me. You've been through your 5th or your 4th, some may be through your 6th. This is just, unfortunately, I hate to say this, it is kind of normal. And those of us who've been this before, don't panic. We just don't make stupid decisions. So, the problem is, even though we've been here before, and it seems like an uphill climb, that doesn't make it any easier. And put it bluntly, there are people out there who've lost their job in the oil and gas industry who will never work in the oil and gas industry again. And there are people who had good jobs working for Baker Hughes or Schlumberger or somewhere in manufacturing that have lost their job and will never get a good manufacturing job again. It's important that we find ways to train them or put them to work, or they'll find the job making less. But the industry as a whole will do fine over time. In Houston, the region will do okay over time. It's just we need to get through this. We need to find ways to help out those that are struggling. So what are we going to expect over the cycle? Probably lose about 56,000 jobs. And this number is a little different than the number I showed you earlier. And by the cycle, I'm talking about not this year or last year. I'm saying from when we peaked in June of 2014 to whenever this thing finally plays out, looking at probably playing out by the middle of the end of this year, the layoffs, probably the middle of this year or the 3rd quarter, we'll probably see all the energy layoffs done with. Of course, there'll be some layoffs occur in the secondary sector, but we'll probably see a loss of about 56,000 jobs. And that seems like an awful lot, and it is an awful lot, but that's 56,000 jobs out of an economy that has 3 million jobs. So for these people, yes, it's going to hurt. For the other 2.9 million, they're going to be impacted, but they're not going to lose their livelihood. So borrow an expression from real estate, location, location, location. For the last 18 months and the next 18 months going forward, the closer you are to the drill bit, the more your job is at risk and the more your business is at risk. The first people who got hit with the layoffs were the oilfield service workers, those who were out on the rig floors, actually drilling the wells. And then it got back, if you're not drilling as many wells, you don't need as many rigs, then it got back to the manufacturing workers because you don't need to replace. You don't even need to make replacement parts for your drilling rigs, because if you stack 1,300 rigs and your cash flow is real tight and something breaks on a rig, you're not going to order another part. You're going to say, that rig over there, take a wrench. We're going to take this part off and we're going to use it to replace it, which is what depresses manufacturing, but it also means at some point we'll start to need to making some replacement parts and start needing to building it up. But the closer you are to the drill bit, the more your job's at risk, the more your business is at risk. So we're probably going to see office vacancies rise and rents dip. If you look at their 4 different firms I use, Transworth and JLL, Collier, CBRE, they all have different methodologies, all different databases. But you can look and see they're forecasting anywhere, this last year we already saw vacancy rates go up anywhere from 2 to 3%. You add in sublease space. The oil and gas firms had these, what's the expression, your eyes are bigger than your stomach? And they said, oh, we're going to need another 400,000 square feet of space at the rate we're growing. And then finally they were, oh, maybe we have about 500,000 more than we need. And they put it back on the market as sublease space. You're most likely going to see the effective vacancy rate, once you factor in sublease space, to go over 20% in this downturn. And it sounds like a lot, but in the summer of 1987, the vacancy rate was 35%. So yeah, things are going to get, I like to say they might get mushy, but they're not going to collapse. If you look at industrial space ought to do fine in the industrial market, because 2/3 of what we do here is warehousing and distribution. It's not as much manufacturing, so we'll do okay with our industrial market. Retail is going to remain tight. Retail, for some reason, they did not overbuild this last boom. They're very slow to build, following the rooftops, putting in grocery-anchored centers, so we're not going to have a collapse in the retail market. Home sales are going to slip. We sold over 91,000 homes last year, both resale and new homes. We'll sell fewer than that. Metro studies come out. They're forecasting that we'll probably build about 25,000 new single-family homes this year. That's down from about 29,000 last year. And that 25 may slip a thousand or two, but it's not going to slip dramatically. What you're going to see is a big shift. A lot of the homes, there were an awful lot of homes that were being built for the upper end of the market. I'm talking about homes of 500, 600,000, a million or more. Because when you had two income family, both of them working in the oil and gas industry, both of them making 200,000 a year. So you had a household income of 400,000 a year. Yeah, you're building $1 million homes for them. That market has gone away, but there's this need for homes between the price of 150,000 and 350 or 400,000. That part of the market will remain fairly healthy if you could find lots to build on, because they prepared lots for a house, $1 million home. You're not going to put a $200,000 home on a $1 million home lot. Now, this is not a forecast, but I want to let you know there is a study out there that I've read that says home values will probably slip 3 to 5% this year, 3 to 5% next year. Now, that's not a forecast. It's not the partnership's forecast. It's just something I've read. But you need to put that in perspective. Over the last 5 years, home values have gone up 35% in this region. So if we give back 3 or 5 or 8%, we're still ahead of where we were unless you bought your house in the last 6 months. So the worst part of the market, though, the thing I'm most concerned about is the apartment market. It is already getting ugly, and it's going to get a lot uglier. The red this is changes in rental rates, annualized rates based on what was happening in the fourth quarter. And areas that people consider to be hot and cool and everybody wanted to get into, think about this. The Heights is already seeing softness in the market. Montrose is already seeing softness in the market. You look at the Galleria, the Inner Loop, already seeing softness in the market. And it's only going to get worse because we have 29,000 apartment units under construction right now. Remember that slide I showed you? Well, the 23,200 jobs created last year. We're building more apartment units than jobs that we're creating. So if you want to move into an apartment, wait about 6 months. You're going to get a really good deal. And so please, 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 no one please build any more apartments out there. It's sad because in a boom time, we were able to absorb maybe 12, 13,000 units when we were creating jobs at 100,000 a year. If we're only going to create jobs at 20,000 a year, we're definitely overbuilt, and this is going to be the worst part of the market. So vehicle sales, though, still remain strong. The auto dealers are doing well. It's kind of a sign of consumer confidence. Most people won't go out and buy a car. They figure they can't make the note. So let's shift the question rather than when will prices to recover, but what would be a reasonable price for oil? What could we expect for oil? What I did here is I went and took the average price of oil and I adjusted it for inflation. I said if the price of oil was quoted in 2015 dollars, what should it be? And if you look at, we had this long period in the 90s when oil traded for $35, $40 a barrel, adjusted for inflation. But then we had this run up here, and we got down to now we're trading around the mid-30s. And so there's this concept in statistics and in finance, this reversion to the mean. You're going to have volatility. It'll go up and it'll go down. But over the long run, you're going to go back to whatever the average price is, the average range is. So the question is what is average price of oil? Should the average price of oil be the $40 a barrel, or should the average price of oil be this $80 a barrel? And you kind of wonder, well, what happened here? Well, this is a real wonky slide. It's constant GDP per capita for the non-OECD. But think about it. Look at this. This is economic growth in the developing world. And it's measured by amount of GDP per individual. And you can see we had this flat period right there corresponded to the flat period there, and then we had this growth in the emerging world. It's what drove up oil prices. So if we're going to reach a new mean, then you'd expect there to be a continued growth in the emerging world. That's not going to happen anytime soon. The IMF cuts global growth outlook. Bloomberg, who comes to the rescue of failing emerging markets? Emerging market turmoil flashes warning lights for the global economy. So what drove oil prices up, especially the growth in China, isn't going to be there. And so we're probably going to expect to see oil prices, a reasonable oil price, maybe more like $40 or $50 a barrel, not 60 or 70 or 100. We're probably in for a period, as you hear everybody saying, lower for longer. 26 is too low, 108 is too high. I would probably say we'll settle in somewhere probably around $40 a barrel when we eventually settle in, whenever that period is going to be. So, when prices do recover, what are the oil companies are going to do? They're going to pay down some of that $200 billion in debt. They're going to pay their shareholder dividends. Some of them are suspending dividends or cutting them in half. And they're going to drill more wells because they're going to use their cash flow to go back out in the field. But there's not going to be a hiring binge. You're not going to see a huge uptick in hiring because the oil and gas companies become flush with cash. As we talked about, they've gotten really good at finding oil with 1,300 fewer wells. We're maintaining, barely losing production, and with fewer staff. The oil and gas industry is getting very much more efficient, so they're not going to need the same level of staff to grow their production. So I keep on saying, yeah, we've been here before. Now, did I show this one the last time I was here? This is one of my favorite charts of all. See someone nodding their head. She remembers it. This is nominal price of oil going back to 1990. And you can see where it is. And you can see we had a period of flat oil prices. We had a period of gradual increase in oil prices. We had a spike in oil prices, a dip in oil prices, a gradual increase, and then volatility again over the last 25 years. And so we've had these periods of just steady prices and extreme volatility. Now, overlay that with employment in the region. And look what happened. In spite of what's happened with oil prices, the region has found a way to grow. And if you go from 1990 to 2015, that's 1.2 million jobs that we've added. In periods of slow oil prices, in periods of flat oil prices, of rising oil prices, falling oil prices. And so 2 points I want to make here. One is we do find a way to grow eventually, even in a low oil price environment. We might have to go through a little bit of correction, but it doesn't determine our future. We talk about oil and gas, talk about oil as being the driver of Houston's economy. I want to introduce maybe a different concept, but a concept from mechanics again. Maybe oil is not the driver of Houston's economy. Maybe it is the governor, in the sense the way you have a governor on an engine or a governor on a motor. And what a governor on a motor does is it controls the rate of speed at which an engine or a motor turns. It governs the rate of speed. So when oil prices are low, the governor clamps down and the engine of Houston's economy turns a lot slower. When oil prices are high, the governor opens up, Houston's economy turns a lot faster, you have a faster RPMs, and the economy grows a lot faster. And maybe that's the way we should be thinking about oil prices, is they're the governor or they're the juice, but they're not the determinant. So I say, we've been here before. I'm not a Pollyanna. I do see that Houston has a long-term, the region has a long-term bright future. It's just the next 18 to 24, maybe 12 to 18 months we need to get through. And I'm not a pessimist either, because there are problems out there, but there's the potential. I'd like to think that maybe we should be somewhere in the middle. They acknowledge, yes, there are people out there who are going to lose their jobs, people are going to lose their houses, people are going to lose their businesses. But also there are people out there who will go through the economy, and this will be something they read about or they talk about, but they'll continue to bring home a paycheck, continue to go off, send their kids to college, continue to take vacations. And so if you want to look at Houston long term, this is December job growth over the last 25 years. You can see some years we have slight drops, some years we have great growth. We have 1 year where it's extremely bad. We lost 110,000 jobs. That's the global recession. That's the Great Recession. That was a collapse of the real estate markets. That's a collapse of the financial markets. That was a collapse of the oil and gas industry. Didn't matter what city, what state, what industry, what country you're in. Everybody got slammed in 2009. You take away this, and you look at Houston has periods where it may lose a few jobs or not gain any jobs, but we really don't have any periods where we go and we lose a huge amount of jobs. And that's probably what we're going to see going forward. We'll probably have maybe a year or two where we have either no job growth, or we might lose some jobs. We might lose 10 or 20,000 jobs, but we're not going to have a year where we lose 110, 120,000 jobs. We just need to remember the long term, we tend to add jobs. So, toward the end, the outlook for Houston, the outlook for the region. Can you guys make something out in the mist there? Now, Houston's not going to disappear into the mist. If you think about it, we're still going to have 8,000 ships a year still going to sail up the ship channel. They're not going to stop calling on Houston just because oil prices are down. And we're still going to add over 100,000 residents a year. And it's going to be a demand for retail, demand for housing, demand for education. And even if no one moved here, in a typical year, we have about 95,000 babies born every year in the region. We have about 35,000 deaths. So you subtract the deaths from the births, you're still going to get an increase of 60,000 a year. So that means 10 years from now, there'll be 600